Ben Cook joining us now, portfolio manager at Hennessy Energy Transition Fund, and Dryden Pence, the chief investment officer at Pence Capital Management. Great to have you both with us. Very interesting setup today for this conversation. I'm looking at oil right now, WTI at 111 right now. We're up almost 11%. Brent at 107. So we've surpassed it in terms of crude prices. We are now north of Brent. So Ben, let's start with you. With us holding firmly above 100 and watching WTI go over top of Brent, what's sticking out to you right now? How are the markets assessing this situation from your viewpoint?
Yeah, good morning. Thanks for having me. Look, this is a headline-driven market, and I think the reaction to the Trump speech last night speaks to the administration's resolve to see a change in Iran, and that includes escalation in military activity, potential boots on the ground. These are all real scenarios that the market has to digest, and I think what it means ultimately is that the magnitude and the duration of this supply outage is likely to magnify and continue, and that's the reason for the upside in the commodity today.
And Dryden, you're much more constructive in the notes that you sent over. Do you think the markets are actually overpricing the risk here, given the resiliency that we've seen through much of the economy?
Absolutely. This is a traffic problem. It's not a supply problem. And so when you have a global commodity, we're somewhat traffic constrained. We have a hall monitor sitting on top of Straits of Hormuz. What we need to do is remove the hall monitor and everything works out. And so the point is this isn't like the Ukraine war where you had a supply problem. We have plenty of supply. It's just a matter of getting it to the right place. So that means once this temporary hall monitor situation occurs and is over with, things are able to return back to fairly normal. We'll be elevated, but we're not going to be elevated at 100. We'll probably fall back down to the 70, 80. It won't be the 40. It won't be the 50 to 60. It'll be the 70 to 80. And at $80 a barrel, the world's in pretty good shape. So I think that this is more of a temporary set of circumstances, and we're far more constructive on this. This doesn't change our view for the whole year.
Now, Ben, you have a slightly different viewpoint here. You are calling for sustained triple-digit oil with potential spikes here. What's your worst-case scenario, and what's your response, I guess, to what Dryden just said there?
Well, I think there's some truth to what Dryden's saying. Look, if you look at the futures market next year, the price, average 12-month price in 2027 is roughly 65. So the market is anticipating some calming and actual supply improvement into next year. And I don't think anyone in the marketplace today expects that we have a continued outage of the current magnitude into next year. I think there is an expectation for resolution. But look, the reality remains, if you're out 12, 13 million barrels per day, as we are right now, of crude oil, and 3 million barrels a day of refined product, there are significant inventory impacts that will require a lengthy period of time in order to restore those impacts. And so, what we're saying is, as long as this conflict continues and inventory levels continue to be depleted, that's just going to be that much more time that's required to build those inventories back. The market will price itself on days forward cover of demand. And as long as that inventory levels is reduced, prices will need to be higher to incentivize additional supplies back in the market. So, if this goes on another 2 to 3 weeks, we could easily see over the next 6 months an improvement in pricing to the downside for the benefit of the consumers around the world. But the reality is, as long as we see the outage on the magnitude that we see today, there is the real tangible impact to inventories that will support higher pricing, potentially over $100 per barrel. Look, it's not out of the question. We saw the Russian-Ukraine impact back in 2022. Prices reached $130 a barrel, stayed over $100 a barrel for a quarter or so. But those are real impacts that the market will have to resolve over the longer term.
And Dryden, one place we are seeing the immediate impact is in gas prices. I mean, we're nationally north of $4 a gallon here. How concerned are you about a potential uptick in inflation? And what does that mean for the Fed from your viewpoint?
Well, I think the Fed is probably, the Fed's not going to raise interest rates. I think they may be on hold about lowering interest rates, but I don't think they're going to be raising it. So I think we'll be maybe having a longer extended period of stable interest rates where we are. But when we talk about local domestic gas prices, I mean, again, these are probably fairly short-term things. When you see gas prices above $5 a gallon, we see demand destruction. I mean, Bubba turns to Leroy and says, we're going to take in your truck today. I mean, and what happens is people that don't normally carpool start carpooling. We've seen this. $5 is the number, and once you hit $5, then behavior changes dramatically. People start carpooling, demand destruction occurs, and it comes down. But I think all of this is based on a situation of time, and it's just a debate of whether this is a 60-day phenomenon or a 6-month phenomenon. And I'm on the side of it's more like 60 to 90 days. You're already having agreements or things with countries, with Iran, even in their current regime, of trying to figure out how we get more oil through. They need the money more than everybody needs the oil. And so economics is going to win over politics here one way or the other, and it's going to do so quickly.
Well, I really appreciate you both being with us today to take a closer look at oil and oil prices. Right now, we're looking at WTI crude at $111.48 a gallon. Brent is at $107.81. Thanks to Ben Cook, Portfolio Manager at Hennessy Energy Transition Fund, and Dryden Pence, Chief Investment Officer at Pence Capital Management.